Welcome to um, the second edition of the Media Review for 25-26. The objective for our exercise normally is to get a sense of how the economy is behaving, and therefore also a sense of how what we hope to see in the next few months to a year. It's as the ticker for the session indicates, clearly it's turbulent times. We seem to have uh, economic challenges, and we also seem to have uh, a range of political challenges which are translating into economic challenges. So uh, turbulence seems to be present continuous rather than a change, a shock to which the economy adjusts. And we should hope that things will, eternally hopeful that things will stabilize. Maybe not get better, but stabilize at least. So this is also the first time we are meeting with a reconstituted team who undertakes the exercise. Um, as some of you might be aware, we had Dr. Radhika Pandey as one of the key anchors for the presentations in the last few times. She's not with us anymore, which was a shock personally and professionally to many of us. And while she's not with us anymore, I think we'd like to remember her personality, but also her extensive academic contributions, her amazing will to put work first in the most tenuous of situations, and her interest in a wide range of issues related to the economy, to the macro, and her willingness and ability to be an exemplary team leader. So, if you could all join me for a minute of silence, we can. So we'll begin the session by doing a round of introductions of our new team. We have from NIPFP, Rudrani, Manish, Vrinda, and Madhur. They will take us through different components of the macro of the Indian economy. And we request Dr. Mandal to lead the conversation to help us understand the nuances in what's getting presented. Over to you, sir.
Thank you, Kavita, and let me join her in wishing everybody a very good morning, and especially welcoming the two new members of our team. Actually, Madhur used to work with Radhika, and I noticed that a lot of Radhika's traits you see in her. Uh, Couple of words about what we're doing. We have now been doing this now for several years. There was a time when we would do this actually in collaboration with the NCAER, and Varnali was a key member of that team. For the last 2-3 years, we've been doing it as biannual presentations of the kind that we are having today. There is one important difference in what we are doing this time, and that is that as Kavita mentioned, times are so turbulent that it really doesn't make many sense to use our forecasting model. It's a fairly robust model that we have, which we've been using. But in this situation, it probably is inappropriate. So we are doing this time what we have done once before, which was during the COVID times. We abandoned the model and forecasting and so on, and based on conversation with people working in different sectors, etc., we came out with an assumed expectation of what would happen to GDP growth in that first quarter. And Bornali that time was leading that exercise. And remarkably, I remember we came out with a number. What was it, Bornali? It was exactly what happened. Now, I don't think we can take credit for it. Maybe a coincidence, but our non-model based forecast actually performed much better than the model based forecast. Anyway, so we're going to do that this time. So we are going to look at scenarios rather than do the usual type of modeling based forecasting. In the first part, initially, Vrinda and Madhur are going to take us through the global economic situation, the global economic outlook, and its implications for our external sector, trade and so on, all the discussions that are going on tariffs and so forth. And this will be then followed by Rudrani taking us through the macroeconomic outlook, both real sector and inflation. And she is going to present those three scenarios that I was just mentioning. And then after the tea break, we are going to have the sort of policy-oriented sessions. Madhur will take us through the monetary policy and the financial sector. And Manish will close the presentation with the fiscal sector, both central government and state governments. So with that, let's get going. Vrinda.
So I'll be starting with the global developments. On the left-hand side in the graph, as we can see, the blue bar indicates the world growth in 2024. Orange bar indicates the projected growth for 2025, and gray bar does it for 2026. Now, we saw that growth sort of rebounded in 2024 from relative moderation in 2023. Now, in early 2025, we saw higher tariffs being imposed by the US under Trump administration. But despite that, the countries have performed better than was earlier expected. So there are key factors for it. One of them being front loading, which is acceleration of shipments by exporters to preempt high tariffs. So we see that that has sort of cushioned the expected fall in growth. We see massive investment in artificial technology, especially by US, China, and Japan, followed by a lot of investment in semiconductors by US and Japan, which has kept their growth rates afloat. We also see fiscal and monetary policy stimulus in many countries. The notable exceptions being Japan, where we are anticipating a rate hike, and China, where fiscal relief might come down in next months in face of rising public debt. We also see successful trade diversification efforts. So major exporters like China and Japan, they've been able to successfully diversify their exports away from US to EU and ASEAN countries, which has again, kept their growth afloat. Now, but there are, negative drivers which sort of pull down this number. Now, we know that there is US tariff shock, which might weigh down on exports, and then there are reciprocal tariffs which the countries might impose in response to higher US tariff, which might weigh down on global economy as a whole. Then we see war in Ukraine and Gaza, though things have sort of moderated, have started moderating, but then it has had impact. So earlier we saw elevated commodity prices and then supply chain disruptions, tighter financial conditions. So at least for this financial year, we do see some of its impact. Then there is weakening consumption demand, especially in advanced economies, US, UK, Japan, China. And amid elevated food prices, we see that consumer confidence has remained muted. Then there is continuing property sector crisis in China, and which might have its spillover impact in form of supply chain disruptions and adverse impact on key countries which are heavily dependent on China for their exports, because China is a major iron and steel exporter. We also see labor market softening. So the unemployment rates are gradually rising in the US. And also we see job openings as a share of total jobs, it has sort of started coming down. We also see curtailed immigration, which has sort of had an impact on immigration flows. So these are the key factors due to which we expect that next year the growth might moderate to 2.9% globally. Then mhm.
On these negative drivers, the US tariff shock, of course, is a dominant story. Everybody's aware, and you mentioned there also the curbs on immigration, which is affecting the supply side of the labor market and rising unemployment. But maybe the shock that the US is delivering as the largest economy in the world is much broader than just the tariffs and so on. Because as Kavita mentioned in her opening remarks, politics is spilling into economics. And they have been so disruptive in terms of, shutting down departments, chucking out people, etc., etc. I think the disruption in the United States beyond tariff is so sharp that some of these forecasts which show that, it's not a big deal, not much, maybe not factoring in all these issues. And we'll come to that later when Rudrani makes a point. But please can continue.
Yes. We saw world inflation. It has sort of moderated from high of 5.9% to 4.2% this year, which is majorly driven by stabilizing energy prices. We expect most of the advanced economies to sort of meet their inflation targets next year, except for US, because we expect further moderation in inflation. The downside drivers, major downside drivers, are low energy prices, which we see will sort of continue to stabilize. We see weak consumption demand, especially in advanced economies, which will sort of which might keep prices at bay. We see property price softening in some of the major advanced economies. Even expectation for property price we see in major economies like UK, US, they are sort of coming down. However, the upside risks do prevail because most of the countries, as we saw in earlier slide, they've resorted to fiscal and monetary policy easing. Then there is the scenario of high tariffs. And we see that food prices are elevated in some of the countries, especially advanced economies of US and European Union. So now Madhur will shed some light on global financial developments.
Thank you, Vrinda. So on the global financial developments front, we see some peculiar patterns coming about. Where in the advanced economies, we see that the ultra long-term bonds have elevated. And this is despite the fact that central banks across...
Can't read everything, so just explain to them what the line.
Yes, sir. I'll take us through that. So this is despite the fact that central banks across have been easing their rates, with Japan being an exception where due to inflationary pressures, the Bank of Japan started increasing its rates. But even there we see that the bond yields are elevated. Here in these graphs, we plot 30-year bond yields and we mark the major significant events that have led to elevation or downside to the yields across US, Germany, France, and Japan. Now, one thing to note is that ultra long-term bond yields are very sensitive to any changes in fiscal fundamentals of a sovereign or a country. So if they're elevated, it basically means that investors are perceiving higher fiscal concerns associated with that country. Now, the rising fiscal concerns are on account of increasing fiscal deficit to GDP ratios and thereby debt to GDP ratios. Along with that, tariff-related uncertainty and the jitters that consistently keep on coming in the world economy and the inflationary fears associated with that. Along with that, political instability, particularly in countries like Japan and France, is also muddying the fiscal scenario there, which is keeping the yields elevated. Apart from these main fiscal concerns, there's also another concern that's there, or basically a development, where central banks are pursuing quantitative tightening, which basically means that central banks are stepping out of the bond markets and price-sensitive investors are stepping in. They are also keeping the yields elevated. So all in all of these fiscal concerns are leading to investors now preferring medium and shorter term securities rather than longer dated securities. So one thing as a conclusive point to this slide, we see that investors are very well factoring in fiscal concerns and tariff-related jitters when it comes to investing in the bond market. But that doesn't seem to be the case when it comes to global stock markets.
Well, before that, there's one thing, just go back to the previous slide.
Sure, sir.
One interesting thing we notice is that the central banks are, on the one hand, they are trying to reduce interest rates. On the other hand, they are trying to tighten the, so you're seeing these two opposite kind of policy components in several central banks across the world, and it's something worth keeping an eye on. Please continue.
So on the global stock markets, we see that apart from the month of April, where you have the reciprocal tariffs coming in, markets have largely stayed buoyant. And this is on account of the 90-day pause in the reciprocal tariffs, along with sequential trade agreements between US and EU, UK, Japan, South Korea, etc., which basically brought down the uncertainty and it improved the investor sentiments. Along with that, there's optimism around artificial intelligence. And the fact that economic data has fairly been okay within the first half of the financial year. However, this buoyancy is coming out despite the fact that tariff jitters have not really gone down. And uncertainty on all levels, economic, trade, geopolitical, everything is elevated. Maybe not to the level as seen in April, but it's still elevated. So it basically is sort of representing that investors are downplaying the impact of these tariffs on growth and inflation, perceiving them to be transitory in nature and would quickly be reversed. Coming on to India's external sector, here on the top left-hand side, we have a graph for merchandise trade, while on the top right, we have services trade. Green bars represent exports, yellow bars represent imports, and the red line represents trade balance. While on the lower left-hand side, we have a cumulative figure for exports, imports, and trade balance for the period April to September for the current financial year and the previous financial year for both merchandise, that's in orange, and services in blue. We see that in September 2025, as compared to the levels last seen in July, there's a slight moderation that's coming about with respect to merchandise exports. As a result of which, growth in merchandise imports surpassed that of exports. Merchandise imports grew on account of higher imports of gold and silver, while exports grew on account of drugs and pharmaceuticals, etc. But their growth was curbed by contraction in ready-made garments, textiles, etc., reflecting the impact of the 50% tariff that was imposed by the US on India back in August. On the services front, we see that there's a contraction coming in with respect to both the components, with the contraction in imports being larger than exports, as a result of which we have a surplus here. And cumulatively, what this has led to is that our trade deficit has slightly moderated to 59.6 billion USD from 60.9 billion USD in the previous, in the same period, previous financial year. On the overall balance of payment scenario, we first look at current account balance. Here on the left-hand side, we have the components of current account balance, where in red you have goods, gray represents primary income, which basically includes wages, salaries, rental incomes, etc. Green includes green denotes secondary income, which basically includes foreign aid, remittances from abroad, etc. And yellow denotes services. While on the right-hand side, we have current account balance as a percentage of GDP. We see that the current account balance has turned negative to 0.23% of GDP as compared to the surplus being registered in the last quarter of the previous financial year at 1.32%. However, this time the deficit is slightly lower than the deficit that was reported in the same quarter of the previous financial year, that is June 2024, which is at 0.91% of GDP. Now, the fact that current account balances turned negative, that's largely on account of rise in merchandise trade deficit, which is due to higher imports in non-crude oil and non-gold and silver category. Surplus trade, services trade has remained in surplus when compared with the same quarter in the last financial year. And secondary income has also improved due to higher remittances. On the financial account front, here again we plot the components of financial account with reserve assets in blue, green representing financial derivatives, gray representing direct investments, yellow representing portfolio investments, and dark orange representing other investments, which basically includes flows in the form of external commercial borrowings and non-resident Indian deposits. Here, when we compare the June 2025 quarter with the same quarter in the previous financial year, we see that there's a minor moderation.
These graphs actually are packing in a lot of information, and it may take you a little while to really absorb it all. So discussion we will postpone for later on substantive issues. But if you need any clarification on what the graph is showing, please raise your hand and we can clarify that now. Continue.
If you could just explain the reserve assets, because that's
basically just your foreign currency assets that are there in.
This is both
gold,
public and
foreign
private.
currency assets.
Okay, both public and private are holdings of
Central bank.
Central bank.
Yeah.
Thank you.
Okay, so comparing the June 2025 quarter with the same quarter previous year, we see that financial accounts have the flows have moderated, largely on account of other investments, financial derivatives, and direct investments, while we see a marginal improvement coming about with respect to portfolio investments. All in all, what this has led to is that rupee has depreciated. With widening trade deficit, elevated US yields, and sustained capital outflows, there's depreciation that has come about in rupee. Here in the upper panel, we see...
Nominal.
Yes, nominal rupee. In the upper panel, we see total foreign exchange reserves as green bars and real effective exchange rate index as the blue line, while the nominal rupee dollar rate in the form of orange line. On the lower panel, we have the RBI forex interventions, with dollar purchases being represented by blue and red representing dollar sales by the RBI. Now, this time onwards, the rupee has depreciated even more as compared to what we were seeing in the last financial year. And this is also on account of RBI holding back with its forex interventions, which has kept our forex reserves buoyant around 700 billion USD. Our forex reserves have also been buoyant on account of gold reserves increasing. From April to September, RBI has added $11 billion worth of gold reserves to its forex reserves. Now, I would ask Vrinda to go deeper into the structure of India's foreign trade. It's actual purchase.
I guess it's both. Value has also gone up. No?
Yes, value has gone up, but they've also increasingly added to the forex reserves.
After it, it's both.
Thank you, Madhur. So now in this graph, if you see, the blue bar, it indicates exports in April to September period 2024, while the orange bar explains it for April to September 2025. Now, these are the top destinations, top 10 destinations where our exports are going to. Now, in the bubbles beneath, we can see the percentage change with the green indicating positive change and orange indicating negative change. Now, what is very striking here is that US continues to be India's largest export partner, and we see that its share has gone up in part due to front loading. Now, very importantly, except for US, India's trade, export trade remains largely diversified, which sort of mitigates a US-like situation with other countries. Now, despite US dominance, 80% of our exports, they remain unaffected by tariff hike. India has been trying to sort of accelerate its diversification efforts to Africa, Latin America, and ASEAN countries, but despite that, we don't see much traction there. But it might change in the coming months because India is sort of fast-tracking its negotiations with some of the countries. Now, despite signing a trade deal with UK very recently, we do not see much share improving there. In fact, it has marginally gone down. So it might sort of rise in the coming months. And UAE has, very importantly, it has turned out to be a very important export destination with its export share rising in the past few years. So yeah, that is something to look forward to. Now, in this graph, the bars, they indicate India's top 5 export sectors. And the width of the bar, it indicates the relative size of the sector. Now, within the bar, different colors, they highlight top 5 export partners of India, their share basically. Now, what we see is that now engineering goods, which consists of all types of machinery, aircraft, automobiles, auto parts, nuclear boiler, everything which sort of India exports to other countries. Now we see that the share going to US is 18%. So while it is magnanimous, but that shows that, I mean, India's exports in this particular sector are relatively it's diversified. And there is, despite US being a major exporter of India, there is a lot of variation across the sectors. Now, if we see petroleum products, which is second most important sector, the export share going to US is only 8%. Now, though it's not a tariff sensitive sector, but still, the sector is very largely diversified, which is, and there is much room for diversification. Now, electronic goods. Now, this is not a tariff sensitive sector as of now, but this sector is highly concentrated. Now, 56% of our electronic goods, they are going to the US. And as we know that US is promoting a lot of investment in semiconductors, we might see, some tariff hike under consideration. So this definitely is something to look forward to and worry about. Then drugs and pharma, it is again, 32% of our exports are going to the US. Now, recently, 100% tariffs have been imposed on this sector. But the good part is that it is on the branded and patented products. So 90% of our exports in this sector are in generic drugs, which is sort of exempted as of now. Then gems and jewelry has sort of emerged as a very, it has, so initially we see that US was sort of having major share in this sector, but now UAE, so share going to UAE is 33%. So we see India has been able to diversify its exports to this country. So there are vulnerable sectors, especially engineering goods, drugs and pharma, and gems and jewelry. A few other sectors which have not been included here are textiles and marine products, which sort of have 35%, which is going to the US. So, but as I said, there is a lot of room for diversification.
Just a couple of things to, probe a little deeper. So you said on electronic goods, it is not a tariff-sensitive sector.
As of now.
So these chaps are, the exporters, they're paying that 10%.
Yes.
Nothing more than that.
Yes.
But we don't know.
Yeah.
It depends on the negotiations go. And on drugs and pharmaceuticals, they've already imposed very high tariffs, but on branded
and patented.
Thing, and on patented, and ours is mainly generic. So unless they do the same thing on generics, we are okay.
Yes.
Finally, on gems and jewelry, Qatar being such a small country, such a large importer of gems and jewelry, do you have any views on what's happening? Is it just for re-export, or they're really consuming all of this themselves?
Yeah, so they are really consuming it for themselves. So after India came into trade agreement with them, which was specifically for gems and jewelry sector, we see a lot of trade. After 2022, we see a lot of traction there. So, and it is mainly for self-consumption. Yeah, and they are.
I have a small query. It seems there was a report recently that India is the largest shrimp producers in the world. Shrimp.
Chimdi.
Chimdi. And I'm from Odisha, and there is a lot of shrimp production also in the Ravan, and they were expecting that after the tariff, this is going to be severely affected. And now, as she just pointed, that marine products are not that much affected. It means how that plays out.
No, sorry. So marine products are affected definitely. Here I have included top 5 sectors. So if you see marine products, that is 11th most important sector. So definitely 35% of our exports in this sector are to the US. So this sector is affected. But India is looking for diversification to ASEAN countries because they are very large importers of shrimp. So we are trying to diversify our efforts there. Yeah. So now what we see is that US has been having very selective bilateral trade deals with the countries. For instance, with Japan and South Korea, it has just had a trade deal, and we see a lot of investment has been promised to the US. Similarly, according to the sources, China might be sort of relaxing some of its export restrictions on rare earths. Now, unlike some of these countries with which US already has a trade deal or is contemplating a trade deal, India holds very little leverage. In fact, India might be opening its agriculture and dairy markets, which have been relatively closed in the past as part of its negotiations with the US. So even the 10-year pact which India has, defense pact which India has with the US, it is to boost US weapons exports to India. So the key point here is that India has very little leverage with the US. And very importantly, more than half of India's export services are for the US, putting roughly 3% of GDP at stake. So we know that US has just increased its H-1B visa fee to 100,000 USD. Then there is a proposed Hire Act, which is halting International Relocation of Employment Act, which might put 25% outsourcing tax on largely diversified Indian services sector. So a very important point to make here is that India has very little leverage, firstly, and secondly, our services exports is heavily dependent on the US. So in such a situation, US has a very strong leverage. So this might very well guide how the trade deal moves. Now we see diversification efforts which have been made so far. Now, after US has imposed high tariffs on majority of its trading partners, we see India has been accelerating its efforts to have a trade deal with some of the countries. Chile and Peru, very recently, India is having these discussions. Now, what we see is that firstly, India is eyeing entire block or region rather than going country-wise. So it couldn't have one with GCC, which is Gulf Cooperation Council, and now it's moving in a phased manner. And second, very important thing to note out here is that India is trying to have a more comprehensive economic partnership rather than a simple tariff deal with the countries. Now, the key beneficiary sectors, in case India is able to, negotiate with some of these countries, are pharmaceuticals, textiles, engineering goods, which are our vulnerable sectors. Now, these trade negotiations with Eurasian Economic Union, European Union, and UK become very important because they have a lot of focus on IT services, which is our very vulnerable sector. So let's see how the negotiations goes, but I mean, these are something to, some points to look forward to. Now, these are some of the key insights from our trade story. Almost 90% of global trade is independent of the US. So 10% global trade is guided by the US, but it is not catastrophic. Then almost 80% of our merchandise exports are independent of the US, so which leaves a lot of room for diversification. Now, there are tariff-sensitive sectors which are highly concentrated, like drugs and pharma, textiles, and probably electronics in future. But as we just explained above, there is a lot of room for diversification, and India is sort of trying to, gain traction there. So policy priority in this whole scenario is diversification rather than being dependent on having a trade deal with the US, because we know that, as I just explained, India has no real leverage over US. Now, although merchandise exports are important, but the real risk, it lies in highly exposed services sector, because 50% of our services are dependent on the US. And given that US has a lot of leverage and we see countries, sort of bowing to US whims to a certain extent, we see that there is a lot of risk here. So services export diversification is most urgent. Now, merchandise is important, merchandise exports, but service sector exports should be diversified. That should be the focus, policy focus.
So your key sort of advice, if you were advising policymakers, instead of falling over, bending backwards to try and get some deals on the merchandise export side, you have no leverage. So, but to focus on trying to diversify on the service side, that's where we really have exposure to US, and they can hurt us very badly. That's your key message. Okay.
Now, Rudrani ma'am will shed some light on growth numbers.
So, in the backdrop that in the backdrop that Vrinda has set for where our trade scenarios are standing right now. So we are now kind of analyzing what our real sector performances are, what we have achieved, and what we are, what our outlooks are for the next couple of quarters. So the GDP, real GDP growth that moderated heavily, I mean drastically in 24-25 due to decline in public spending, public capital spending in that year. Now we see in the first quarter of the current fiscal, we see there is an improvement in the growth rate, which is mainly driven by the all the demand components, the government consumption expenditure, private final consumption expenditure, the investment, gross fiscal capital formation. But we see that trade deficit, the real trade deficit has widened in Q1 compared to the same quarter previous year, in Q1 of this current fiscal compared to the same quarter previous year. Now, looking at the sectoral performances, these are the recapitulating, because this is just what we have achieved till the Q1. So in Q1, the growth we see that is driven by mainly the services sector, which is 9.3%, is a significant rise from 6.8% in the same quarter previous year. And agricultural growth, which was 1.5% in Q1 previous year, is now in this year is 3.7%. Industry, the growth is concentrated in manufacturing and construction, which are quite high, 7.7% and 7.6%, but overall industry growth has declined in Q1 this year due to the contraction in mining and quarrying and very low growth in electricity and utilities. So this is what we see till Q1. Now, looking at what currently we are, what are our right now, how we are doing. So what we see that the consumption demand, private consumption demand, is the indicators show a sign of improvement is going on, is continuing. So if the first panel, it shows the urban consumer confidence of RBI, which is the blue line is the cursor is not working. The blue line is the blue line is the current perception, where the orange line is the future perception. So where the current perception was sort of flattened till Q1, now we see there is a significant improvement, whereas future perception has been rising since the beginning of this of 2025. The another indicator is domestic sale of passenger cars for urban areas. So that that shows that it was the growth in that indicator has been moderating till the Q1, but we see a significant improvement in the growth rates in the months of Q2. In the rural sector is a bit mixed picture, but overall it's showing a continuous trend of improvement. So the tractor sales, the domestic sale of tractors, the growth was moderately high at 10% till Q1. Now in the months of Q2 there is a huge rise to around 45%. So this is mainly driven by the huge increase in agricultural activities, that is driven by the favorable monsoon effects that we see during July and September. Whereas the indicator, which is sort of a urban, semi-urban and rural areas, the two-wheelers, it shows a sort of a little bit of moderating. But there are many evidences showing that the growth in the fast moving consumer goods, the growth was very high for the rural sector for previous in the last few quarters at 8.4%, whereas that for urban was very low at 2.6%. Now that gap is widening because the urban demand is now picking up. So we see a significant development, positive development happening in the consumer. Gap is narrowing. Gap is narrowing. So we see a significant improvement in domestic demand. For the investment demand, so one of the significant indicator for investment is at a high frequency or in real times is the value of projects that is completed. So if we track that, we see that there was a huge rise in the growth rate of completed projects values in Q1. So that was both driven by the huge rise in real terms, as well as the there is contraction in the previous year, same quarter. So there's a base effect, which was, we see that it was to 22.4%, to 224.5% in Q1. It's that growth was mainly driven by the public sector. We see in Q2, although there it has reduced because the base effect has been faded away, but it's still high at 30%, and again they're driven by public sector. So we see that there is a growth in Q2 is going to be significantly high, driven by the strong investment growth in the economy. Now here we try to give try to see what's our projection for Q2 and the next couple of quarters, and overall 25-26. So our baseline projection is 7.1%. This projection is based on a completely information-driven framework, where we extract information from around 18 to 29 indicators, and it's is estimated using a dynamic coefficient model. So we assume that the relationship of these indicators with the overall economic performance it's varying over time, is not constant over time. So that's just a data-driven, information-driven guess is 7.1%. That's the projection. That's for 25-26. For Q1, our projection is 7%. For Q2 is for 7%, Q3 for 6.6%, and Q4 for 7.2%. If we compare our estimates with projections with RBI's projections, so we are at a little bit higher side for the yearly projection, but our Q2 projection is completely is the same as the RBI projection. That's what we find. Although we see it's higher in Q4. Yeah, so that can be driven by the fact that consumption demand is now rising, and investment demand growth is although right now it's high, but its multiplier effect will decline. So generally we have seen that the multiplier effect from investment demand growth remains there for around 2 quarters. So in the Q3 we expect that the multiplier effect will moderate from investment demand growth, but in the next quarter the consumption demand growth will pick up. So that's how it's going to increase. So this is our baseline scenario. Now what we have done, we're looking at we are trying to have our best guess about so this is suppose we were there was no trade shock, no Trump shock, and the GST restructuring was not in place. So this would have been, given the information we have till September, we would have achieved. Now what we are trying to see that, okay, now we have GST restructuring has happened, and with the 50% tariff is slapped on India. So given this scenario, what could be our best cases? So these scenarios are derived from a structural model, reduced from structural model, which is outside this this information driven model, and it looks into account the different feedback of several macroeconomic relations with the aggregate economy. It's the households, the consumption, investment, then trade, then tax, the government budget, budget equation. So all this, after with interaction with all this, what we see that under a scenario, suppose that after the restructuring of GST, we are going to have a 1% effective GST rate cut we are going to see from Q2 in the H2 of 25-26. If we see it is a decline in GST rate by 1%, and for US growth scenario, we are assuming three situations. The optimistic situation is when it is higher than 1% from the potential. Pessimistic is when it is below 1% from the potential, and the third one is that it's just near the potential, because there are a lot of ranges of projections of this output movement of US, which are not, which is giving different values, and is not that only one is not showing up only one direction, whether it will rise or decrease or will remain unchanged. So given those three scenarios, what we find that our projection for under the optimistic scenario will be 8.8% real GDP growth. Pessimistic will be 6%, and if we assume that US GDP will be near potential, then we are going to have a 7.4% growth rate. So the intermediate scenario, that's when the last one, when the effective GST rate declines by 1%, all the impacts on the in the economy is coming through this channel, but the trade channel is now closed, because not actually affecting this feedback, because US is at the potential in this. So these are our three best guesses that we can have, given the all the turmoils, or the turbulence that we are having in the Indian economy right now in a global context. Yeah.
Inflation?
But you're saying a 1% reduction in GST rate adds about 0.3%.
You go back to the previous.
Yeah. It's that will so in our so this is the net effect. It is, if it is 1% decline and US GDP is higher than their potential as well.
The last one.
Yeah, then it is 0.3%. 0.3%. Yeah.
So then it's not assuming that US output
Is not not impacting. Yeah.
In the afternoon, we discuss all the data details. So we can get
That how I'm getting into this. So it is, will describe the model in details and how we get to this. Now coming to inflation. It's a benign situation. We are having 1.5% CPI headline inflation in September 25. This is driven by very sharp deflation in vegetables, in pulses, and also the moderating inflation in energy. However, we see that the core inflation is on rise, but that is due to the rise in gold and silver prices, not any of the services and yeah, yeah, part of core.
You will leave out energy and
At the core, I do it in a so that we look at in a sense that even in the miscellaneous category, which is a part of core, we have the convenience, the petrol and diesel prices which are used by the household for convenience. So that we take out. So that we take as a core in the sense that we take the fuel and light and also this part. But gold and silver, I have not taken out yet, and maybe we'll see. That's the
what is the weight given to gold and silver in our CPI answer, do you know?
I exactly don't remember right now. And but it's not very high. But the thing is that the inflation rate is so high that now is impacting. The weights are not that high, but the rates are like around like now 36%, 26%. So that's impacting the core.
So now your inflation.
So given this background, our inflation projection is again benign. It's we think that we are going to have it's 1.6% in 25-26. However, the upward risks are that beyond so demand, we have seen that the consumption demand is increasing, so that is going to might pull up the inflation rate in future. And the download factors are that because of tariff shocks, now the producers are not able to sell their products in the export market, so that is going to have a negative impact on inflation rate. So that's what that can be the. So it's both sides. The risks are at both sides. However, our projection is even below. So RBI seems to have there is a rise in inflation in the later part of the current fiscal. So that's the.
You say that the RBI's forecast is higher than ours.
2.6%.
1%, but what is that? I can't read it. 0.8 or 1 you said?
No, so this is for the Q4, but for 25-26, ours is 1.6.
And they are saying
2.6.
2.
Yeah.
Oh, 1% higher than ours.
1% higher than ours.
Fine.
So, but again, so when we look at the projections, it should be read in context of some probabilistic, that there is a upward and downward confidence band in which it can take any value of in that period. So whatever projection we have given is the point estimate, but it can, it's like, so this fan chart is basically showing that for 68%, 90 and 95%, what could be the possible ranges of inflation projections that we can achieve during this period. So that's it. So,
1% is quite higher.
from our projection now. Yeah, maybe. So as far I know, RBI uses a structural model for projecting non-agricultural GDP growth and inflation. So probably they're putting their feedback on expected feedback on rising consumption demand, and also that's how they are thinking of. Whereas our inflation projection is again completely data driven, but we can update it with the scenarios also, and maybe that we'll look at later. But if that changes our projection.
I can't remember when our inflation rate was so subdued. Is there any risk that there will be deflation? Or you don't think?
No, I don't think it will be deflation, because consumption demand is on rise. But again, if the trade effect is again, it overtakes, then we might see a very low inflation rate.
The first part of our
concerned is when you have a fan
which is in the going to the negative domain also.
Could be anything.
yeah, it reduces confidence in the policy. So
Because it's now going down because of the mainly the food components inflation. There's very huge deflation in that component. But again, food is very difficult to predict. Food inflation is very difficult to predict. So it's very volatile. So when we do the headline projection, is always the fan is core maybe will show some sort of a.
So we can take a break for tea now and come back for the second half of the presentation, and then formally we'll discuss.
Yes, I would guess.
Okay, so we had the morning pre-tea break presentation. Now we'll get into the more policy-oriented parts of the presentation, starting with monetary policy and the financial sector, which Madhur will take us through, and then Manish will take us to the fiscal policy part. So, Madhur.
So on the monetary policy front, we know that within this calendar year, we entered an easing cycle. On the left-hand side, we have repo rate in black. Blue line represents call money rate, and 91-day T-bill yield is represented by the yellow line. On the right-hand side, we have banking system liquidity graph. Now, this graph is read in the opposite manner, where a negative number denotes a surplus and the positive denotes a deficit. Policy rates cumulatively have been reduced by 100 basis points from Feb till June, where in June, the stance was also changed back to neutral, representing the fact that there's no more space for further policy cuts. Cash reserve ratio was also reduced by 100 basis points. That's going to occur in 4 tranches fortnightly. It started back in September and is going to continue till end of November. As a result of all of these policy actions, short-term rates have inched lower than the repo rate. Call money rate is also inching lower than repo rate on account of liquidity surplus. The banking system liquidity has been in surplus on account of durable liquidity infusion that the RBI did that started back in end of January 2025 till end of June 2025. Post that also, they have been managing liquidity, keeping it in surplus. And it is also on account of higher government spending. On the health aspect of the public sector, here on the left-hand side, we have the gross non-performing asset ratio for all banks in black, public sector banks in blue, and private sector banks in red. And the same ratio for non-banking financial companies on the right-hand side. We see that the health of the banking sector has improved, and there's a convergence coming into play with respect to GNP ratios, where for all banks, the GNP ratio has fallen to 2.3%. For public sector, it's down to 2.8%, and for private sector, it's down to 1.8%. For the NBFCs, it has also moderated to 3% from a 6.8% peak that was registered back in March 2020. So given the fact that we have a easing cycle, 100 basis point rate cut in repo rate as well as CRR, along with the fact that you have a banking system surplus coming into play, the only other thing to look at is that what is the transmission of these policy actions to the government, to the economy at wide. Now, one thing to note here is that the most effective channel for monetary policy transmission in India is the interest rate channel. So to track transmission, we look at 2 things. We look at the lending and deposit rates of the scheduled commercial banks, and we look at the bond yield movements. So we see that transmission has been more effective for fresh deposits than loans. Here are the first 2 columns. They represent the fresh, interest rates on the fresh loans for both public sector and private sector banks, while this side of the table represents fresh deposit rates we see that the transmission towards fresh deposit rates is almost complete, while it is still partial and incomplete for lending rates. This time onwards, also, the transmission towards lending rates has been pretty fast and that's primarily on account of the fact that lending rates of scheduled commercial banks are now linked to external benchmark lending rate. So just as a side note, just to explain what that is, any lending rate of a scheduled commercial bank is composed of two components. You have the benchmark rate, which is adjusted by the central bank and should move technically in line with the monetary policy changes. And then you have a spread, which is borrower specific. So that basically changes from one borrower to the other on the basis of their credit worthiness, etc. So this external benchmark lending rate has meant that now the lending rates of banks are exactly tracking repo rate, because now it's repo rate plus the spread. Also on the front of margins of the bank credit, we see that during any easing cycle, margins come under pressure. But if we just look at the proxy of, which is just the difference between deposit rate and lending rate on fresh loans and fresh deposits, we see that the margins have been healthy. They have not really gone down by that much. They've actually gone up, and they're excessive at this point. And the fact is that you have banking system surplus in place, liquidity in surplus, and you have such massive margins, but still you have incomplete transmission towards lending rates. That's an issue here. Coming on to the outstanding loans and deposits, this basically represents the already existing loans and deposits in the banking sector. Here we see that the transmission is more effective towards the lending rates than the deposit rates. And the transmission here is also faster on account of the fact that you have EBLR coming into play. But if we look at it over here, the transmission towards outstanding lending rates is better in private sector banks than public sector banks. And this is primarily because in private sector banks, you have almost 88% of the total outstanding floating rate rupee loans linked to EBLR, while in the public sector, it is around 47%. On the bond yields, here on the left-hand side, we have government bond yields with 10-year yields in red, 5-year yields in green, 3-year yields in yellow, and 1-year yield in blue. And the same thing on the corporate bond yields for the same maturities. And these are for AAA rated corporate bonds. We see that from April to June, where we have monetary policy easing, we have the higher surplus being transferred by the RBI to the government, we have lower inflation trends, and we have the change in stance of the monetary policy to accommodative. We see that there's a significant easing coming into play for the bond yields in the government GSEC market. However, in July and August, they hardened. And this hardening is coming about because the stance changed back to neutral. There was GST restructuring and the tariff imposition, the 50% tariff that was imposed by the US on India in August. However, in September and October, there's a divergence coming into play, where shorter term yields have actually moderated, tracking lower inflation prints, but the 10-year yield has hardened, tracking the fact that the indicative borrowing calendar for GSEC for the second half of the financial year is reflecting that there's going to be an increase in supply of these 10-year bond yields. So overall, what we're seeing is that the term spread, which is just the difference between long-term and short-term maturity yields, that has widened. And this is also partly because of the fact that investor preferences are shifting from GSEC market to equity and corporate bonds. And corporate bonds largely have mirrored the trend in the government bond yields. So the fact that transmission has been faster and we have the easing cycle in place, we should technically see bank credit increase. But that doesn't seem to be the case. On the left-hand side, we have bank credit monthly, YOY growth rates of non-food credit in red, bank credit to industry in blue, personal loans in yellow, and bank credit to services in green. While on the right-hand side, we have fortnightly growth rates of deposit growth in blue and credit growth in red. On the left-hand side, if we just look at that graph right now, we see that it's basically during the festive season that you see a slight uptick coming in, tracking the increase in industry bank credit. However, overall, bank credit has remained moderated as compared to the levels seen in the previous financial year. And this moderation is broad-based. It is not just in one or two categories of non-food credit, it's in all categories. Also, if we look at the right-hand side graph, we see that for the first half of the financial year, credit growth actually moderated and it sort of converged with the deposit growth, with deposit growth with hardly any changes in deposit growth. However, it's in the festive season that we see a divergence coming into play, where because of increase in currency in circulation during the festive season, deposit growths have actually come down and are now trailing credit growth. So in a way, bank credit supply doesn't seem to be an issue, given the fact that you have excess liquidity in the market, in the banking system, and easing and everything in place. So then, is it demand side that is an issue then? So
like your this right-hand side is for October from 17th October. So there you will see an uptick, right, in the credit growth.
yeah.
This is still September. So do we have an update on this?
Ma'am, we won't have it till end of November because the data comes out with a lag of a month. So we won't have the picture before that.
So for like the components.
Yeah. So we look at the components of these three broad categories incrementally, which is basically just addition of bank credit month on month. And we see that large industries have been deleveraging for the most part of the financial year. And it is basically your micro and small that are, and along with, to a certain extent, medium industries that are holding down the fort when it comes to bank credit demand. In the personal loan segment, we see that even though risk weights have been rolled back, we don't really see a massive surge coming in with respect to bank credit demand here. It is only loans against gold jewelry along with vehicle loans and housing loans that have held down the credit demand. But apart from that, none of the other categories are seeing an offtake. On the services, sorry.
Is there a definitional issue? Why is there this significant reset in April 2022?
Man, that's just the financial cycle of the industry. So in April, they start planning and then they start taking up as the time. Yeah. So it's like
mentioned is a very sharp switch.
Then when we say incremental, it is incremental to what?
To the previous.
Same corresponding previous year.
Otherwise, it's not compared because they are seasonally different.
So I get, and if both Aprils should be low, right? Both Aprils start a new cycle.
Yes. Both Aprils are low here. Sorry.
So the stocks, the levels will be lower in April for both.
Everything for both years.
So why do we see, if we were repeating this over multiple years, we'd see the same thing.
Yes, exactly.
So it is a sanctioned loan in April, which will get dispersed over the course of the year,
something like that. Ma'am, we have to go deeper into this because this is a very interesting pattern that has come about. But yeah, it's sort of like that. On the services sector, we see that components have not really picked up, with NBFCs largely deleveraging here also. So then where is this credit demand going? This credit demand is actually going to the capital markets. So corporates are increasingly tapping capital markets for financing. The fact that monetary policy transmission was faster in the bond markets, that just meant corporate bonds were cheaper than bank credit. As a result of which, if you see the June quarter here, we see that there was a 75 basis point rate cut here, 25 in April and 50 in June. And we see there's a sharp surge in corporate bond issuances as compared to the same quarter in the previous financial year. And almost all of these corporate bonds are issued through private placement routes, which basically means that public issues are literally not there. So your secondary market is illiquid because investors here tend to hold the bonds till maturity. On the equity market also, which is on the lower part of this slide, we see that initial public offerings have also taken up within this year, with small and medium enterprises along with large corporates also increasingly tapping the capital markets. Especially in the September quarter, we saw a record number of corporates raising funds through IPOs to the tune of around rupees 210 billion. And we saw the largest wave of IPO listings since December 1996. And these IPOs are majorly dominated by corporates in manufacturing and non-financial services. And a total of 136 companies raised finances during this quarter. So all in all, it just looks as if it's not a problem that bank credit is not picking up. Financing is there. People are able to tap different sectors of the market to get financing. So that is not an issue. We should now basically look at the fact that whether this financing is actually going towards productive sectors or not. And also the fact that banking sector earlier was the only source of financing. Now the financing market is deepening with more sources coming into place. Now I give the floor to Manish sir to talk about. Sorry.
Go on to the fiscal side. So basically, your story here is that you're seeing disintermediation.
Yes.
Banking sector is getting. So two questions that raises is A, are we seeing along with this buoyancy and corporate, borrowing from capital, raising reserve capital market, is this showing up in corporate investments also? I mean, that's something that we should ask Rudrani, whether there should be, if this money is being raised, that means either they have run out of excess capacity and now want to invest, or sentiments is whatever. But if they are raising resources, what are they raising it for? That's the question that we need to ask. The other thing you referred to it, but you didn't explain. Maybe we can do it later.
Yeah.
Is you mentioned about when you look at the new fresh loans and fresh borrowing on the one hand, and the outstanding loans and borrowing, that there's an inversion.
Yeah.
I mean, in one case, one is happening faster than the other. Do you have any views on that? Why that's happening?
So outstanding loans are generally a little sticky when it comes to transmission, but fresh loans are faster because they're able to adjust pretty quickly. It's yeah.
It's also there's a stock and flow issue.
Yeah.
The outstanding loan is a kind of stock, but the inversion, what?
By inversion, we mean that.
What I mean is that in the case of
fresh loans, the deposits are adjusting faster.
Yeah, the transmission gets inverted between outstanding and fresh. See what I mean? Any views on that? If you don't have, doesn't matter. But it's something we need to think about.
Sure.
One tag on question is from the earlier chart. Does it make sense to argue that the corporates reaching out to other forms of financing, would that potentially put pressure on the banks for their margins to go down, or should it?
It should technically put pressure on the margins of the banks because for them, then that basically means they don't really have demand. And if that's
component of demand is this.
Yes, which is a major portion of their demand because if you look at the credit aspect, it is the large industries make up a pretty big chunk of bank credit in India. Even though the growth is like moderating and it's less, but it's still significant. So if these are going to other sources, it will bring bank margins under pressure for sure.
But that's not happening. When you look at the bank margins, that is your conclusion.
Yes.
That is in fact not happening. And I don't know the answer, but one possible answer is that we have a very state-dominated financial sector. 70-80% of the bank, I'm talking about bank resources, are from public sector banks, and a lot of those who are raising the money are also public sector, government especially. So it is not very market responsive, and you would expect a market sensitive thing if the margins will go down, but they're not happening.
Yeah, because even for the private sector, it's not good.
Private sector margins are lower.
No, they're higher.
Oh, sorry.
They are
even
3 points. Yeah.
This is really strange, and not going down because of this, diversity, the disintermediation. So these are all questions that we don't have to answer now, but these are things that we need to look into. Okay, can we move on to fiscal now?
Yes.
Yeah. So let us now look at the finances of both the central and state governments. So we begin with the. It's not moving.
Yeah, it's moving.
So let's look. If we begin with the revenue position of the union government. So in the table, the first three columns, the first two columns talk about the year-on-year growth between April, September 25-26, that is the second column, and then the first is over 24-25 April, September. The third column is what the government had budgeted in 25-26 and how is it different from the revised estimates, and then last two columns will talk about the scenarios which Rudrani just spoke about. So if you look at the finances of the central government, you see that gross tax, there is a sharp decline in central government tax revenue. Gross tax revenue during April to September, the first half of the year, fell sharply to 2.8% from 12% in the previous year. And this was primarily due to sharp decline in income tax growth, which fell from 25% to 4.7%. And this was expected because in the budget, the government had actually announced increase in exemption threshold for personal income tax. You also see a fall in central GST growth from 10.8% to 5.8%, and corporation tax growth also declined to 1.1%. However, on the tax side, you see there is an uptick on excise duty growth, and this could be probably due to increase in excise duty rates on petroleum and petrol and diesel that was announced sometime in April. We see a very high non-tax revenue growth of 30.5% compared to the previous year, and this is primarily due to enhanced dividend from RBI. In May, they announced an increased dividend of 2.69 trillion rupees, much higher than what they announced in the previous year. As I had said that in the 25-26 budget, the government had actually announced an increase in exemption threshold for personal income tax, which has an impact on revenues. And further, again in 22nd September, it rationalized GST rates of around 450 goods and services, and both of these are likely to have impact on the revenues, both in the short run, adverse impact in the revenues, at least in the short and medium term. So using the
This is so not captured in your data.
data captures all data capture. So these changes do not capture the GST rationalization, but it does capture the reforms in the income tax. So using the alternate growth scenarios, which just Rudrani talked about, which incorporate the impact of GST restructuring and tariff shock. So we have this optimistic scenario and we have the pessimistic scenario, the last two columns. In the budget, the government had budgeted for an increase in GDP, nominal GDP increase of 8%. So based on Rudrani's growth projection and inflation outlook, in the optimistic scenario, the nominal GDP growth over RE would be about 10.4%, which is much higher, 2.4% higher than what the government had budgeted. And if in the pessimistic scenario, it would be around 7.6%, 0.4% lower than what the government had budgeted. And if you look at what would be the impact of that on the gross tax revenue, and this is as compared to the revised estimates. So in the optimistic scenario, the gross tax revenue of the central government remains more or less same as in the revised estimates. So clearly it is still lower than what they had budgeted. And in the pessimistic scenario, we see a contraction in the revenues of the government compared to the revised estimate number, and which again is basically much lower than what they had budgeted. So in the short run, it is likely to have an impact on the revenues, what the government had budgeted in the budget. Adverse impact in the what they had budgeted in 25-26 budget.
That you're seeing.
Yes.
It has not captured for the year because the last date for payment of income tax was September.
So every year it is either.
It was not last year. It was not September.
Last year it was July or August, I think. So
you would have captured that. For last year would have captured.
Partly it would have captured, but most of it is on account of. See, you had 25% growth, and then now it is 4.7. Partly what you are saying is correct, but most of it is on account of this income tax exemption limit threshold was increased, so that is because of that. Now,
tax threshold is increased, corporate tax should not be moderate.
Yes, but we see a slight decline in growth. GST should not moderate, but then there has been a decline because the growth in consumption has not been much as expected, or the previous year growth in GST was much higher, so it might capture the base effect also.
This brings us to often mentioned in our own internal discussions that just looking at growth rates can be
very misleading.
At levels. And the growth rate always shows up. The change in growth will always show up in the steep change in level or whatever. But to abstract from levels and just look at growth rates, you don't get the full picture.
Put it as a point of GST.
Yeah.
As a percentage of GDP.
So you much better
picture than. But since we are talking about 6 months H1 period, as a percentage of GDP, it might also not give a real picture. So over last year, levels would capture a much better scenario than as a percentage of GDP, but.
But what do levels tell you? They're just in the bigger numbers.
So it just tells you over the years how have levels have.
What it does
compared to
that it puts the change in growth rates in perspective. Because you see what is the base effect. If you just look at the growth without looking at the base, then you can get a very distorted picture.
Yeah.
But anyway, these are substantive.
And a lot of fluctuations, then what you're saying is true. But if you have a systematic growth, then year on year, there is every year there is base effect. So the base effect has no value unless you're talking about very volatile.
Yeah.
Right?
So if you have in a volatile situation, looking at only growth rates and dramatic changes can be very misleading. That's the point I'm making. But if you have a very stable everything moving, then it doesn't matter. But will
These tariffs are
Sorry?
backloaded. You get the major effect of those tax collections.
Yeah.
Yeah.
Not even analysis. No, that's why you presented them.
So income tax will show the effect because your
Even in most of the government revenues and expenditures.
Expenditures are primarily backloaded.
no, but for
income tax is not backloaded, no?
Quarterly, huh?
26 it would be backloaded because till September 31st they are not reporting, and the return, refund, and everything was going after that. So you would not get the exact figure for the year, at least for the particular year.
No. I think we have to make a distinction between personal income tax and corporate. What do you mean not reporting? Corporates may not be, they may be postponing, but for in quarterly,
all the TDS advance tax is playing out
yeah.
on a quarterly basis. So.
But anyway, these are very integral. We can come back to discuss. Let him finish his presentation.
So coming to the expenditure side of the central government, we see a sharp increase in capital expenditure growth during April-September vis-a-vis, and if you compare it with the previous period, there was a contraction of sharp contraction of 15.4%. Revenue expenditure growth also fell to 1.5%, and we see a sharp contraction in subsidies in this half compared to the previous, and this is primarily due to more than 20% decline in food subsidies. For 25-26, the government had budgeted capital expenditure to increase by 10% and revenue expenditure by 6.7%. Major subsidies budgeted to remain at the 24-25 RE level. In the budget, the government had set a target of fiscal deficit target of 4.4%, which was lower than what the government had actually set for itself, the goal of bringing the fiscal deficit down to 4.5% in 25-26. That was done in the 21-22 budget, and so it is lower than that. But due to the recent GST restructuring and all, we think it is still achievable. The target is still achievable, possible if capex contracts in H2 and offsets the loss in revenue due to GST reforms. And if you look at the government estimates of loss in revenue due to GST compensation, due to the GST rate rationalization, it was around 48,000 crore for this, and which is basically
second
half, and which is basically 0.1% of GDP. So your FD is 4.4%. If you factor in that 1% loss, it will be 4.5. So basically, government is basically as far as fiscal deficit target, most probably it will achieve that. And in the budget, another thing that has happened was the government announced a switch from to a new fiscal monitoring regime, from fiscal deficit being the anchor. Now it is the debt GSDP ratio will be the anchor, and it also set out a fiscal consolidation roadmap for the 5-year period starting from 26-27, and with debt GDP ratio being the anchor, it gives more elbow room for increasing capex and also having running higher fiscal deficit, which would be helpful in reviving economic growth. So let us now look at the
what you're saying before we move on to the states.
Yes, sir.
That on the revenue side, things have been looking very pessimistic.
Very pessimistic.
The big question is, how do they respond to it? Do they let go of the deficit and maintain robust expenditure, or they stick to the deficit target, which would mean a big cut in, especially in capex? And I think the implication what you're just saying is that by switching to this different monitoring system, where the fiscal deficit of the year doesn't matter so much anymore, that possibility that they would stick to maintaining expenditure in order to continue to sustain growth. Maybe, guessing, we don't know.
Yes, and with the new anchor debt GDP as the anchor, the change is very small. Any
Of course,
change
because
in
it's
debt GSDP ratio to a large increase in
same,
fiscal, so it
it's a
definitely
stock and
gives,
margin delta.
yeah, so it gives. And if you look at the, if we consider the two scenarios, the total expenditure is based on RE and BE on the based on 425 RE. In these two scenarios, the total expenditure would be higher by 2.8%. But if you compare it with BE, 25-26 BE, which shows a total expenditure growth of 7.4%. So of course it would be lower, but then compared to RE, it would be, so the impact is very marginal in the sense, in a very limited model that pro-cyclical actually. And that is also and it's a six months window, so that change might not be.
Like irrespective of what's happening to the revenue, expenditure doesn't respond.
It's not very.
It's not
So
It's not sensitive.
revenue expenditure is large part is committed expenditure which you cannot contract. So the only room available for contraction
CapEx.
is capex actually. So let us now look at the state sides. So if you look at the states, so this is aggregate across all states. So total revenue receipts of all states during April, August, so first 5 months, grew at 6%, which is similar to the rate at which it grew in the previous year, and it was
Very difficult for you to follow. Yeah.
so okay. So now, if you look at the own revenues, which account for about 68% of the total revenue, so total revenue of states can be disaggregated into own revenues and the central transfers. So 68% of the total revenues come from own sources, that is own tax and own non-tax revenues, and central transfers again comprises of tax devolution recommended by the Finance Commission and the grant. So if you look at the growth in own tax revenue, which accounts for 89% of own revenues, the own tax revenue fell from 9.2% to 6.1% during first 5 months of this year. Though there is large interstate variation ranging from contraction in case of Tripura to a very high increase in case of Jharkhand. Central transfers show an increase from 3.1 to 6.3%. And if you look at the components of central transfer, that is devolution and grant, so you see a fall in devolution growth, but even sharper moderation of contraction in grants in aid growth. So basically that resulted in overall central transfers increasing by 6.3%. Now, if you look at the last column, which is what states in aggregate had budgeted and how it is, what is the growth, what is the change over the revised estimates, you find that these assumptions or these projections which the states in aggregate have made seem somewhat optimistic, because if you look at the own revenue growth in the first 5 months, it was 5.9%, but states have budgeted for a 14.5% increase. Similarly, own tax revenue, what we achieved in the first 5 months is 6%, whereas they have budgeted for a 14.1% growth, and so is true for the non-tax revenue. Even their GSTP growth projections seem somewhat optimistic. Now, given that we have had GST rate rationalization, and which we saw it would impact the revenues of the central government. Now it will also have an impact on the revenues of the own tax revenues of the state government, and also the own revenues of the state government. And given that there is a contraction in own revenue on the own revenues of the central government, through that the transfers, the devolution also, and as well as grants going to states would get affected. We've not quantified it, but it gives what the results from the central government impact shows that similar thing might pan out both in terms of fall in own tax revenue as well as impacting the transfers to states. So we see the whatever budgeted, whatever growth they have budgeted in 25-26 may not be realized actually. Let us
before you go on, just I'm leaving out the budget thing. But that's it's aspirational. And leave it. But if you look at comparing 24-25 and 25-26, look at central transfers. The growth rate almost doubled, right? 3.1% went up to 6.3%. Now, that would suggest to you that some component of transfers, the growth rate has increased. But you look at devolution, it's high, but it's declined. If you look at grants in aid, it has declined even more. So, but it's negative, but actually maybe that's what accounts for it, because the 30% decline is now only 17%.
But still very high. So if we were to look at the levels, I think that would give a much more clearer picture in terms of one can conceptualize or visually see what has happened.
What is actually happening.
What is actually happening actually.
Okay.
Now, moving on to the expenditures, we see that the combined capital expenditure of states increased by 14% during the first 5 months of this year, as compared to a contraction of 6.8% in the last year. Last year we had the elections, which actually resulted in not new works or not capital works not being taken up because of the election code of conduct. So that could explain the contraction in capital expenditure in the previous year, and on that, but this year you see a 14% jump over that lower base actually. And capital expenditure is a very small component of the total expenditure. Most of it is in the form of revenue expenditure. In 25-26, all state capex is projected to grow at 15%. Revenue growth, expenditure growth was at 8.1%, and in 25-26 it's budgeted to grow at 9.2%, and though moderated but still high. And if you look at in 25-26, states in aggregate have budgeted for a fiscal deficit of 3.2% of GSDP, and opposed to the 15th, and what the 15th FC target was 3.3%. So, but if you look at the revised estimates for 25, the fiscal deficit of all states was around 3.5-6%. So you find there is a moderation in fiscal deficit in their budgeted numbers, but it is still marginally higher than the target specified by in aggregate. We've not looked at we are not presenting the statewide analysis, but then it is a lot of variation across states in terms of fiscal deficits and all. So that ends the fiscal outlook of the center and state, and I'll stop.
Now we're waiting for comments.
Yeah, so thanks a lot for bringing us sort of up to date on various developments across the economy. Before we allow anybody else to step in with comments and questions, I'd like to request Dr. Bhandari to share her thoughts on the presentation.
Thank you, Dr. Rao, and thank you, Dr. Mandal and Rudrani, for inviting me. Good afternoon, everyone. It's good to be the other side of things commenting rather than doing the whole macro thing. So I'm going to divide my comments in macro and micro sort of things. So starting with a macro, I do want to congratulate the whole team. And Madhur, I think it was very interesting that you pointed this out on the whole banking issue, because I was just reading an article yesterday by Tamal Bandyopadhyay, I don't know if you've read it, is essentially he's talking exactly this problem where the CASA, where the banks are don't they are suffering from this exact issue, and the CASA accounts are depositing. I think the one interesting thing that people, one of the things the author has mentioned, and I think it's interesting that it's not often looked at, is there are structural issues, changes, and everything that is taking place. But the fact is that just like innovations, like financial innovations, like just-in-time funds, how does, because Sir was mentioning that government is the same, actually keeps a lot of money with bank accounts, but because of just-in-time funds and the usage of e-Kuber platform, the governments are not keeping funds with the banks, which has also led to banks not having money. And how does that affect the overall situation? How does that affect transmission and public finance and issues? I think, and these are some of the issues that one should look at, that while there are nice technological innovations, but how does that affect public finances? And it's not often looked at from a public finance perspective. So I think that's something interesting. But I'm glad you raised it, because that was one of my points that I was going to talk about. What about the CASA funds? What about these structural changes that are taking place in the banking sector? Just slowly people are not depositing in the money, and more people are actually taking, apparently investing in mutual funds. So how does that affect? That's one clear thing. The second one that I want to talk about is the nominal growth. It's not often talked about, but I think we need to start bringing that in. Given that Rudrani's inflation rate is is showing the moderating, the other indicators are mixed or uncertain. What is actually the growth rate, and what is the economic dynamism in the sector? What is the growth dynamism in our country? And I think this point is often missed. If because we know the problems with the computation of GSDP, the whole inflation rate scenario. I think this begs us to question, and this also ties us down to the point on public debt, because, and this is something Dr. Mandal had only asked me, and this I often wonder, because if you look at that paper by Sajid Chenoy, with his, we must maintain 9% nominal GDP growth rate for our debt to be sustainable. Are we maintaining that? And then that's something we need to start thinking about more on a regular basis as we go ahead. The third point, another point is, this thing is that actually, even though I don't do macro anymore as on a regular basis, people still think I do macro. So even if they just call me as if I know the answers, but sometimes I don't know the answer, so I end up researching. So yesterday, so somebody called me and said, "Do you know the impact of GST, long-term, short-term?" I said, "No, I don't know." But anyway, I said, "Why don't you look up Sukanya's and Bhanumurthy's paper?" So that's an old one. I said, "Yeah, still, that's the only one I have." So anyway, so actually, because then he sent me a picture, so I didn't even have to search for it. So because it was just ready there in my WhatsApp, I'm saying the impact of GST in the short run is around 1%. So the GST moderation, how much of that is going to actually play out, is something you guys can actually. I'm sure either you're doing it the next half, or it's something to look at and think about as you go on. And we know that it affected only a few of the sectors. And the other thing is, this and this is something that based on the research that I have been doing, is on, we do the NCR Business Expectation Survey. While it's a small survey and probably doesn't reflect the country as a whole, but it still gives us some insights. So in September, we were doing the survey because it's fixed when we do this. And other than the fact that business sentiments are moderated, especially with the future sentiments, we asked the firm specifically that, given the US tariff policy, how are you going to manage this? Firstly, it's a very small proportion of about 17% of our firms were affected by US tariffs. That's the one thing. The one thing is we asked them, okay, what are the kind of changes or how would you react to it? And the first thing they said is that they would obviously, redirect some of their products to the to the in domestic markets, substitution, and of course diversify to other markets. And the other thing, when we ask them what kind of government policy you want, they are said that we want more free trade agreements, of course, to expand markets. Nothing very sink in what you were saying. But the other thing that they said is, again, ease of credit constraints. And this point I just want to bring up, that I've been to two, three forums, and this even every forum we keep on hearing this credit constraint issue. That when one sector is saying, "Oh, it's so difficult to get credit constraint, credit in India, expensive and difficult," so we're just thinking we want to ask for FDI. I said, okay. I mean, I don't think so. The government of India is going to buy that kind of thing. But still, the credit constraint issue, especially by MSMEs, it's a recurring issue that keeps on happening. And again, that ties is a transmission. What is happening there, and what can we do about it? That's one thing. But the other point that when we looked at this, I again looked at the trade data. What we saw that between August and September, the US trade has sharply fallen by 20% on a month-on-month basis. Very sharply, nothing surprising. The tariffs brought the trade down. But overall trade still went up. I'm talking overall trade. I did not decompose non-oil, non-this thing, everything. I'm just looked at overall. So overall still went up. And why did it go up? Where did it go? And I find that essentially it went to UK and the UAE. And straightforward. And UAE went up pretty sharply. That almost made up for the thing. UAE, of course, is an entrepot, and we have a trade agreement with them. We have a trade agreement with both. So these are I'm just saying raw numbers. So diversifying markets is absolutely a critical issue. But while trade is not the only engine, ease of doing business factor still matters. And I think that's something that comes down to the micro issue of that India has still a lot to gain from the ease of doing business. I understand it's also the purview of the report, but I still want to mention this, that credit constraints, getting licenses, getting approvals, it's still a pain point. And India can gain a lot just by overcoming that. And the point on FDI, if we are not getting domestic capital up, do we go out and get FDI? It's something that's not the reason that I've heard before. It was such a flimsy reason to go out for FDI that you would first want to look out for FDI within investment in your own country. So I think those are my very quick points. And overall, I just want to say is one thing that bothers me is, so what is the driving factor in the economy right now? If somebody was to ask you, what is driving the economy? And the rural consumption may have picked up because of rainfall and other favoring factors. Urban consumption maybe because of GST. How long does that last? Then what are the driving factors? Manufacturing we are affected by trade. We are all in manufacturing sector is always less than its potential. The services sector may benefit because more people are coming back and operating from here. So that way, then so services sector may benefit. But again, services sector is not just the IT sector, right? It's a bigger sector, and what is happening to those sectors? So I think one thing that I would have liked to get from the story is what is the driving factor? Of course, capital expenditure, but how are you going to drive the economy especially in the private sector in the next couple of quarters? And that does not look. Where is the growth going to come from? And that does not look very optimistic to me, at least from what you have presented. It looks a little this thing. So, and where is and that's why the growth numbers, one has to look at it very in a circumspect fashion. Thank you.
Thank you. A lot of questions and things to ponder about. Would the team like to answer these before we open the floor up for, yeah?
Yeah, just on the point in just-in-time payment system that's come about, that is a severe constraint when it comes to banking system liquidity because that flows out, and then you have the forex interventions coming in, that sucks out more liquidity, which is what we're seeing in October in the second half, where due to forex interventions, now RBI has resorted to doing variable rate repo auctions again and again. So this is a point that I was wanting to pursue further on how these financial innovations that are consistently coming in, how are they affecting our banking sector and what can then be done there to sort of improve that. So that's it for me.
Yeah, so definitely. After the trade agreement, we've seen a lot of traction going to UAE, and it has emerged as a major exporter of gems and jewelry. And India is also reviewing its current trade agreement with ASEAN region, and which might sort of, India might have stricter rules of origin in place, which might sort of remove dumping from China. And yeah, UK's, what we've seen is that textile exports to UK have really gone up despite the marginal decrease in the share. So that is something to really ponder over. And yeah, so as ma'am, you suggested that ease of doing business. So that's a very valid point that credit conditions. So the presentation showed that probably the like corporates are not really going for bank credit right now. But yeah, I mean, that is yeah, MSMEs. And especially like you already said this, that I mean, not too much reliance on FDI and what India is doing within, but also like if we see some of the trade negotiations which we have, they really focus on MSME sector. So that is something which we are at least doing outwards.
Now, for concern about the nominal growth. So there's issues in what kind of projecting the nominal growth, because we know how the real growth, what are the things that drive real growth and all, but when we'll come to the projection of nominal growth, we just add the inflation rate with it. But inflation rate is based on CPI, and whereas it's not based on the GDP deflator, and GDP deflator is sort of a mix of WPI space. So all this until and unless CSO comes up with a services sector inflation prices in not the CSO, it's is the economic the Office of Economic Advisors, which is comes with the WPI. So until we have a services WPI, it's very difficult to get hang on, because our the inflation rate, that is our target is CPI, but again the GDP is not based on that. So it's an issue, and it's not, I don't think, is solvable in a short term.
Forecast, but at least track. Yeah, I was stuck somewhere. Like if you're constantly having, I think what I saw the numbers, you're not going around 9. You're just stuck at 9%. So there's no growth. Where did the actual growth come? I mean, your nominal growth is not going up at all. It's I don't know the answer. Maybe I'm wrong, but I'm just saying asking. Is it possible to track nominal growth? Are you stagnant, or are you growing, or are you, what is it? I'm not asking what forecasting.
Yeah. So okay. So that's definitely that may be one important aspect of this thing. About your GST, the impact of GST rate, that what could be that even so in the second half that we are going to present. So basically, it's kind of a based on a we have looked at, given the information till September, what are the nature of the responses of different variables on consumption, GDP, and also, and what we find is that 1%, if GDP, if GST, effective GST rate declines by 1%, so what we are going to have a consumption will increase by 0.7%, and then it will also increase for some point of time, and then it will decline, because that change in GST rate, that impact goes away. So once that goes away, your consumption is back to this thing. But compared to the external demand shocks, what we find is that impact of GST is more remains for a longer period of time. So that that's there. And what is driving the economy? So we find that it's the public. Whenever there is a high growth in public spending, we are going to have a high real growth. But if you look at the what we see in the supply side, so that I have not presented in the main presentation, but we have it in our appendix. If you go to the appendix, so yeah,
The appendix.
let's go to the appendix. No, can I have Manish? Can I have?
It's working, it's working. No, we need to go up.
Go up, yeah, go up, yeah. So, yeah, so this agriculture we see because of the favorable monsoon impacts, we see agriculture is not going to do for next couple of quarters, will do well. On next, if you go to next. Yeah, so industrial performance is actually is mixed and volatile. So what we say that the public spending growth is driving the demand growth. We are going to see a high demand growth, but whether that will it depends also on the capacity utilization. And right now is 70% of the capacity is by the RBI surveys. 77% of the 74% right now is the capacity utilization. So definitely it's not the full that demand growth is going to also drive the respond to the supply side is not going to respond to the full demand growth. But what we what we see is that right now the production of the automobiles is growing at a very high rate, and even if you look at the exports the growth in till September, so the export growth overall has moderated. Several of the main components have moderated or contracted, but it's the automobile growth has increased to say 32%. That growth so is quite high, and that's because of the front loading that in our presentation we have been highlighting to this point. However, the construction, it was till last quarter, it was construction was driving the industrial growth. Now we see that there is a moderation. So maybe for next 2 quarters, construction will be will not be showing very high significant growth.
But the construction growth rate is still very high.
It was 10
compared to earlier.
Yeah,
but it's still high.
That was still Q1. But now in the Q2, we see the finished consumption of finished steel is an indicator for the derived demand from the construction sector.
5%.
That comes down to 5%. Earlier it was stable for a 10% growth rate. Now so construction will now we can see a decline in growth rate. And go to the next. Yeah, services actually. We found that in September it responded to this trade tension. So the port service, the transport port and transport services both declined, but it has increased. We see in October, and again because I think because of the front loading thing. So services, so these components, trade and transport has actually responding to this trade related uncertainties, whereas the telecom is like now booming. And if you look at the next, so financial is again now doing that, not doing very. So I borrowed one from the information from Madhur. So is the credit is now increasing as the deposit is moderating. The mutual fund, there's a lot of activities in the last year, but it's now moderating, but it's increasing, but it's a very low rate. So the growth rate is moderating. So now even the mutual fund market is not that buoyant, that demand is not buoyant. So financial is going to, so yeah, definitely supply may not be responding to that high demand growth, and we may not end up to that very high 8.8%, even in the optimistic scenario. But that's, we can only wait to see what we can come up. Thank you. That's okay.
So now we have.
Oh, acha, Vrinda is something to respond.
Also, I think wealth effect is playing a role because there are some recent reports. I don't have any hard numbers to put to it, but they do suggest that wealth effect is actually driving the consumption revival for the upper middle class, affluent people. So while it might not be the main factor, but it might definitely play some.
There's what also they're, especially the auto people, they're interpreting that as inequality because some of them, the lower demand for lower, smaller cars is not picking up, but demand for big cars is picking up. So like the Tata, all these models. So there is a dichotomy there, and that's why there is a lot of debate that what does it signal?
Two-wheeler demand क्या हो रहा है?
Moderating, sir.
Two-wheeler demand.
Moderating.
It's no.
That really tells you the.
Yes, even within the
So it's
car.
actually exporting, exportable cars that is actually picking up.
Yeah,
Because
so that's one of the
that
things.
export of that has also.
So first, auto sector of course is a very long value chain in manufacturing and we have a comparative advantage in small cars.
Yeah.
And what I've heard industry intelligence is key that they are quite now competitive in the market and they're targeting exports only. They're not even global. They're not
Small cars.
Small cars and the thing they're not even targeting India. So, but what is happening, at least a little bit that I've read the economic history of automobiles is that people are not, we are the first, people who have cars are switching to bigger cars or different types of cars. But then there's no new entry. And that is, and that's a signal of inequality in the system. That people are not switching from two-wheelers to bigger.
Okay, wonderful. Anybody else has questions, comments? Moshmi.
Just, very specific to your, I came in late, sorry, for this half of the presentation. So you talked about the switching to the new fiscal target about GDP, debt GDP ratio. So, but I didn't find anything, any historic, any data in the last couple of years on that particular target. So how is it moving and where we are? You said that it gives us more flexibility to the government in terms of that. So
Yes. Kavita, can I come in for a moment?
Lekha, just 1 second. Let Manish answer the question and then.
My question is related to Moshimi's question only.
Okay. Okay.
Yeah,
Go ahead.
yeah, and she really preempted the question I wanted to ask because the moment Professor Mandal mentioned that the annual fiscal deficit is going to be very insignificant. So now with the low interest rate regime in the next time, it may
Go
go
ahead.
up or am I audible?
We can't hear you properly, Lekha. You're
Better now?
yeah, a little better. Yeah.
Yeah, my question relates to Moshimi's question on that consolidation part instead of fiscal deficit. Now it is debt. But Professor Mandal mentioned that the fiscal deficit, annual fiscal deficit is going to be insignificant. But Ulsav is there. We have done the analysis and this is confusing the market, more than when we had annual fiscal deficit as a target and the consolidation part, when there was a clear medium term part. But now, as Moshimi asked, we have a long term target for reducing the debt without linking it to the annual targets. So, if the fiscal deficit is going to be insignificant, are we going to look into the three parameters like primary deficit, whether it is surplus and the other macroeconomic parameters? Because there is no clear articulation, as he rightly said, about how we are going to do the fiscal consolidation. And it has already started creating confusion in the markets that what exactly is our glide path. Thank you.
Okay. Go ahead.
Okay, so I'll try and answer both the questions actually. So if you look at the 21-22 budget, or prior to that, you look at the 15th Finance Commission's report for the period 21 to 26, they had given a glide path for the fiscal deficit of the union government. But in the 21-22 budget, the finance minister said that our target would be bringing down fiscal deficit to 4.5% without specifying annual reduction target. So we had actually moved away from, for the central government, moved away from annual targets, though the finance commission targets were there, but we have moved away from annual target, and we see also that there is a falling trajectory of fiscal deficit as a percentage of GDP. So that is one point. Now, as regard the question on the new anchor, so it kicks in from the next financial year. For so we stick to the fiscal deficit target for this year, but from next year we move to a debt GDP target. But there also we don't have an annual target, but it's just a terminal year number, 50 plus minus 1%. So we've not yet done the analysis in terms of that, but then of course if you see a small increase in fiscal deficit would add to the stock of debt, that would be very marginal in that sense. So the change in the debt GSD to the stock would be very marginal. So that gives, compared to if you are having an annual fiscal deficit target, it gives them a more fiscal headroom to adjust the expenditure and that. So that is what I think.
My question was more about where we are in terms of sustainability, because that will basically be, whether there's a
In terms of what, sorry?
sustainability.
Ah.
That is the bigger question, whether it shows up in as a small change or not, where we are historically and exactly how it is a headroom in terms of that.
No, fiscal if you look at the debt GDP ratio of the general government, it has been declining over the years, especially more prominent after the COVID, and it was largely driven by a decline in debt GSDP ratio of the central government, and which is the major component of the general government debt. States debt has by and large remained less than 30%, but although stagnating in the last few years, but it's just the central government debt which shows a declining trend. So as far as that is concerned, whether this debt is sustainable or not, we've not done any analysis so far on that, but given that the
No, but there is, Gordani referred to it, there is this paper by Sajid and what's his name, is author, where they reach the conclusion that if your nominal GDP growth rate remains above 9%, then given the interest rates and so on, that your debt will be sustainable. But now, with the inflation rate coming down so much, that's the question she's raising, that
But then that 9% nominal.
whether we remain below above that.
But that requires a more careful study about this potential in context of. Actually, I did some study for some of the major states together. And we find is not that there is some till 25% of the GSP ratio that's sustainable after that.
I mean, when I tracked, I didn't do that work myself, I was reading it. So it was around pandemic, it was 90%. So now it has come down to 88. So now it has come down to what?
80%.
less than 80%.
What, the debt?
Yeah,
That would
that is it. It picked up. No.
Very high.
79.
Yeah.
Center is supposed to, yeah.
No, it's only for the central government, but states have not yet.
Any other questions, comments? Dr. Mandal, you had
I had
a few
remarks really, I'm not sure whether, this is for you, Madhur. Your presentation, we got the picture. The credit is not a problem. It's not a constraint. Whereas some of the stuff that Bornali referred to, she's been reading that constantly people are saying credit is a problem. So I think this, you mentioned it, no, Bornali? Yeah. Yeah, so we need to think a little more carefully about this. I don't think we've got a full picture. The other thing, and this relates to this, what is really the growth picture, when again Bonner is saying we should look at nominal in addition to real, given the mess we are in terms of our GDP statistics and so on. But really, this is a question for you, Rudrani, that what is happening to corporate investment? Are they beginning to invest, or the private investment cycle not yet reviving? Because that's in a way it tells you really about the state of the economy, dynamic or not dynamic, and so on.
So it's we actually when we track this say projects,
the investment projects status and all, what we find is that there is a crowding in scenario in India, and I think Lekha also has in one of her articles has pointed out that. So it is actually whenever their public investment increases, then the private will respond to it by increasing because they feel more confident and all.
Standard pattern here, is it?
Now, overall, it's high. So it's the total. So it's the public has driven the investment growth, and now private is also quite high. Is around I think 17%.
I mean, numbers are not, but you're saying there's a revival of the private investment cycle.
Yes.
That's a
projects was coming down.
No, that is because of in the last year there is a contraction. So compared to that contraction, if you look at the levels, there's a contraction, but it's
This is in this article. Growth may be driven by robust project investment.
Why don't you go to that?
Yeah, so it's actually the base effect, which was that was for the last quarter was very high. High growth was due to the very strong base effect from the previous year. But now it is that base effect has gone down in Q2, but it's still high. The growth, investment growths are quite high. But again, that's why we are saying that the multiplier effect is going to moderate in Q3. So we are going to have a lower growth rate in Q3, but again, consumption effect will pick up in Q4, so we will get a higher growth rate.
If you look at private investment, I'm looking at your graph, September 24, compare that with September 25, it's almost the same. The peak, I mean, the level is this.
No, it's quite high.
Huh?
Quite high.
Is it higher?
Yeah. Distinctly.
Achha. Then that's good. That's what he's saying.
Yeah. Yeah. Okay. So, to address all.
I have done.
I just had one thought on the whole credit MSME banking sector. MSME has historically been credit constrained, and nothing has made it worse, perhaps. So when we are looking at change, we are not looking at whether something has affected their ability to borrow, MSME's ability to borrow adversely. So perhaps the question then is, will banks start being more proactive vis-a-vis MSME lending if other sources of lending for them are going down? And while center government has been trying to do various nudges to support lending to MSME, Mudra loan and everything else, if the story still is that MSME is credit constrained, then we have to re-examine what we mean by what the nature of the constraint is. Because it is not lack of resources and you being lower down in the pecking order. There are resources, banks appear to be flush with funds. So then there is something else which makes them ineligible for lending in some sense. And they also don't seem to, MSME window in the stock markets also have opened up, but they don't seem to want to go that route either. So perhaps there is need to ask what their constraint is, what is the form of their constraint before we can articulate what the what ease of doing business on that front really means. So that is the only comment. Anybody else would like? Yeah.
So the MSME sector not going to the banks for loans is basically the collateral issue, which banks have a mandate. And these new platforms, the Threads, the RXIL platform, these platforms are kind of enabling this or taking care of this issue of the collateral. Their the financials not being in a proper state. So that is being kind of been taken care of in the recent times. Their numbers are still low, not very high, but yeah, this is being taken care by these new platforms, the MSME credit reach. So they are not going to the banks, rather they are just kind of nudging towards the new Oken platform as well as the Threads. So that is being taken care of.
Yeah.
So there are different financing institutions, the NBFCs, which are the lenders into that system.
NBFC getting the money.
From the bank.
That's all. But there was one window where there, I thought the MSME ministry had opened up collateral loans with interest subvention for the MSME sector. They say the public sector banks who have done this on good points, same the public sector banks are, I went to the telecom seller last year and this is we are not going to go because whatever I'm earning is going on spending, will give it back the money. But this is a bank is completely unfriendly. And so I have no option but to go back to go to the NBFC and then these, so and then another firm, but it said, and these are including myself. So I asked them that why not go about credit thing. They said they don't take these credit because we have relations with them. So they are not always responsive to that, what is that thing called? So that is also not working. I said, but you have a history of getting export orders or orders. Why can't you show that? But no, they want is collateral. That's it. Public sector banks, they all want is collateral. The private sector banks are not interested.
Private sector banks are not interested, they basically end up going to the NBFCs, which is this thing. So if somebody has collateral, they offer that, and if they don't, this thing. So if they don't, then NBFCs is the only option. And fintech platforms are coming up, but as I said, double-digit interest rates, and the other thing is. There's always a chance of getting, you don't know what you're signing up for in India. So these contracts have to be delved into detail. So those are, but it's mostly located in tier 1 cities. Whether it has gone to tier 2 or tier 3 cities, one doesn't know yet anyway.
But is the answer then at the end of the day still the whole story of financial repression, in the sense you have a state-dominated financial sector? Banks, if you adjust return to risk-adjusted return for entities compared to what they can do, what for liquidity banking, this money in areas, especially government loans and so on. It's high return, risk-adjusted. So why don't they give money benefits? So the answer to.
So then I would see that you take into it and I think that's the case.
Your what? Yeah. No. So at the end of the day, the real problem is this government-dominated financial sector. Until that changes.
It's not lending. So there's not
No, no, no. No. Private sector not lending because they can lend to the government, na. No, they can then buy government bonds.
No, government bonds. States generate the kind of margin that they're doing.
No. Risk adjusted. Zero risk government bonds. That's what I'm saying. You can't just look at absolute return. You have to look at risk adjusted return. And there, whether it is a public sector bank or a private sector bank, they find it easier to put money there rather than take risk and lend through everything. Or through NBFCs, which ultimately are giving the everything.
Can we continue the discussion behind lunch?
Yes, yeah, or not. Yeah.
Sorry, this year is supposed to come at 2:15, but I think that's possible 2:30.
Yeah.
Good done. Sorry.
Yeah,